Okay, thank you so much. Hey, good morning, everyone, and I really appreciate your giving me your time. This is Mark from Right Line Trading, and I just want to just open up with a little disclaimer. That all signals and trading opportunities provided both orally, writtenly, or electronically are for educational demonstration purposes only, and we are not money managers. And do your own due diligence, consult a financial advisor prior to making any trading decisions. Again, we're not a registered financial advisor, not a licensed commodity trading advisor. So with that out of the way, just let me move on to our presentation. And what we're going to talk about today are dynamic support and resistance volume zones. And they're going to show you how to find low-risk, high-reward trading entries on the futures, forex, and stock markets. And the thing that I think you're going to find interesting is this is really a heavily weighted academic presentation. And this indicator is operational in any market, no matter what you trade, on futures, forex, and stocks. And I think it really does augment any trading methodology that you currently use. Being able to leverage volume as part of your trading is really an essential component towards trading with an incredibly high degree of precision. And by precision, I mean not only getting winners, but being able to filter out the losers. And after day trading for almost 15 years straight, I have to tell you that the most important component of becoming a successful day trader, no matter what you do, and no matter what market you trade, is really having the ability to sidestep losers. Now, I just want you to know that if you stay until the end, we're going to give you my free options alert newsletter. And it's just a present. And I give you exact entries, exact exits. I don't want to take up too much time with this. But that's going to be a free gift from us. We're really, really doing great with the options alert newsletter this month, or this year, actually, 2017. Now, just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. And I've published close to 15 peer-reviewed articles in first-tier journals, and I've been involved in the financial markets for over 20 years. Now, Right Line Trading software is the product of over a decade of analysis of price action, market structure, and indicator algorithms. And the software is based on mathematical modeling of closed systems using multivariable equations, and it's one of the fastest growing trading systems on NinjaTrader. And just to recap what I just said, what we do at Right Line Trading is we look at all the independent variables that go into determining future price movement, and then we place them into a multivariable equation. And then we optimize them mathematically. What we do that I think is very unique is that we determine the sensitivity, specificity, and positive predictive value of every trading entry we take. We look at day trading not as an art, but as a science. And that science is leveraged via the use of this type of mathematical modeling. We don't take any indicator, any system, or any trading methodology as being accurate or to increase our ability to take successful trades unless we prove that to be the case mathematically. Now, here's a picture of me. Everybody tells me to put up a professional picture, and so that's why I put up a funny one. My son just messed up my hair, but you have a little bit of an idea of what I look like. Let me just go through that quick. I wanted to talk about a couple of things. And the main thing is that, again, I don't want you to take anything that is proffered to you by anybody as being accurate, precise, and to help with your trading methodology unless it's been proven to you to work. Remember that the last generation of day trader caused a 95% failure rate, and over the course of time, that failure rate fails to improve. And apparently that 95% failure rate continues to stay static. And what that tells me, and should tell all of you, is that all the trading systems that you're being offered, that many of them remain broken and don't work. So what your trading system, your trading methodology has to do is it has to evolve. And it can't be based on what the prior generation of day trader has done. Now, I know Tony Hansen after me is going to talk about Fibonacci, and I think that she's going to tell you a great way to trade Fibonacci. From that, you can tell that Fibonacci is a very effective tool to leverage in your trading system. But if we look at Elliott wave and we look at oscillators, we've done an enormous amount of mathematical testing to look at the predictive value of using these indicators or using Elliott wave, and I have never found anything to show mathematically that is going to help with your trading entries. The most important thing of all is to leverage volume. And I'm going to show you how to leverage volume to really, really help you out. Now, I'm really basically picking up a little bit where the last speaker left off, and that is you're going to have to build on your own knowledge base, on your own screen time, and on your own experience. It isn't all going to come to you immediately, and you're unlikely to make $5,000 a day or even $5,000 a week when you start. And when I first started, all I wanted to do was to pay my bills and have a tiny amount of cash left over. But really what I did was that I really personally have decided that I wanted to be a millionaire. And I haven't reached that goal yet. But I feel like I have the drive and the dedication. And the biggest thing is the obsession to achieve this goal. And if you have that obsession, if you constantly endeavor to look at what works and what doesn't work, and you sort through a lot of the clutter, you will eventually achieve that goal. And you're not going to start this way, but I'm telling you that that's a goal that you can achieve. Now, I put up this house to represent this, and that is that the market is made up of two distinct groups of traders. There's the institutional traders, and then there are the commercial traders. If we try to beat the institutional traders, we will always lose. The institutional traders leverage an enormous amount of money, and they determine the trend. So we can't beat them, but we can, and what we must do is beat the other commercial traders. They're the small traders just like us. They trade a 2-lot, a 4-lot, or a 6-lot, or they trade 100 shares of stock or 200 shares of stock, even less. They trade small amounts. Their capital is limited, and these are the traders that we must beat. And there's no reason why that we can't do that. There's no reason why that these commercial traders cannot pay our bills, buy us a house, pay for our vacations, and allow us to achieve all of our financial goals. I mean, every time we go out into the market, it's an auction system. People are buying and selling shares of stock, or they're buying and selling futures, or they're buying and selling forex pairs. You just have to be on the right side of the trade. And the important thing is that we're going to walk away almost every day taking money from the other small commercial traders. Now, again, I'm going to show you how to find low-risk, high-reward trades on any market, futures, forex, or stocks, without utilizing a lot of indicators and chart patterns that you're likely to have been taught will work for you and are most likely a part of your trading methodology right now and fail. And that's why 95% of traders hundreds of generations of day traders who have preceded you, or actually come before you, have all busted out of the market. Now, respecting volume profile generated areas of support and resistance is a critical and fundamental component to successful day trading. And I'm going to show this to you and prove it to you scientifically. And I think if you listen carefully, you're going to learn a lot about how to day trade any financial instrument in any market on any time frame. Dynamic support and resistance volume zones are going to make you successful 75% of the time if you have the discipline and you have the patience. Now, I call them 3 secrets, but they're really not secrets. They're really 3 facts. And the first fact is that support and resistance volume zones are dynamic, and they undergo constant adjustment, and they're recalculating intra-candle. Most indicators do not recalculate intra-candle, but remember that these volume zones are based on volume profile, and volume profile is changed every single time a contract, a lot, or a share of stock crosses. Volume profile is a constantly changing metric, so these volume zones are constantly recontouring every single minute. And there's no formal zone of support or resistance. I've seen a lot of indicators where they have blue areas for support, red areas for resistance, and they're static on the chart. There is no formal zone of support or resistance. When resistance breaks, it becomes support. When support breaks, it becomes resistance. So I'm going to show you how to leverage these facts and how to determine when is the best time to pull the trigger and really start making money. If you're not making money now, to turn this around for you, and if you are making money, to ramp it up and make even more. Now, here is volume profile. And you can see in the first profile to the right, you've got a daily, then you've got a weekly, then you've got a monthly. They accumulate volume over a given period of time. So you can look at volume profiles for a given period, a given look-back period. I want you to get an idea of what volume profile looks like if this is your first introduction to this concept. Now, here again is volume profile. And what all volume profile is the amount of volume that trades at any given price. And you can see that it forms a histogram. And this histogram is what creates market profile. And market profile is one of the parameters, one of the things that we use to trade off of. Now, we're going to digress a little bit. So I'm going to show you exactly how volume profile works. Now, here's our volume profile based on our own indicator, the one that I'm going to show you. We keep the volume profile small because what we want to do is leverage the calculations. We don't really need to actually view the histogram while we trade, which is a huge advantage. Now, if volume on any given financial instrument at any given second in time was normally distributed, it would create a perfect bell shape like this. Now, volume isn't normally distributed, but this is the perfect visualization and representation of the concept of volume profile. Now, the center of the bell-shaped curve is the mean price, or the price at which most volume has crossed that day. That's the price that traders in the market on that given day want the price of the financial instrument to be most aggressively. If you're trading a stock, this is where traders want that stock price to be. If you're trading the forex, this is the price where that forex pair wants to be. And if you're trading futures, this is where the price of your future wants to be. One standard deviation of volume around the mean represents the value area. And another way of saying it is that this is fair value for the instrument that you're trading. Again, it doesn't matter what market it is or what the financial instrument is. Whatever it is, this represents fair value. This is what traders have decided is the fair market value for the instrument that you're trading. It's that one standard deviation of volume at price. In order to break out of fair value, it's going to take a tremendous amount of effort for the market to do so. And thus really is the core principle of leveraging volume profile to create market profile. Now, here's another representation of a normally distributed volume profile. Now, I know it's a little bit fuzzy, but I think you can still clearly understand the points that I think are important to make. The POC is known as the point of control, and the point of control is that price at which most volume has crossed. And the value area high and the value area low encompass one standard deviation of volume. And that one standard deviation of volume represents the fair market value for the financial instrument that you are trading. This is where price wants to stay, in that fair value zone, bounded by the value area high above and the value area low at the bottom. Now here's our indicator. And you can see that price is not exactly normally distributed. It's skewed. The point of control is black, and that's the price where the histogram is the greatest. And this is the price, and this instrument is crude, but it could be a stock, or it could be a forex pair. It doesn't make any difference. It could be a bond. It could be a treasury note. The price that traders want this instrument to be is $53.49. That's where most volume is crossed. And that one standard deviation of volume encompasses, it's a little hidden, it's about 53.21 to 53.57. That represents one standard deviation of volume. Now, I just created this blue line to show you where the point of control should be if price was normally distributed. But we know that price is not going to be, it's going to be skewed. Now, again, here's the value area high, the magenta line above. Here's the value area low, the magenta line below. And here's the point of control. It represents 66 2/3% of all volume crossed at price. Now, here are some really important things, important concepts. The 66 2/3% representing one standard deviation of volume is, again, based on a normalized distribution of volume. Once volume becomes skewed, that 66 2/3% no longer holds as the optimal zone for the fair market value of your trading instrument. And I hope I don't confuse anyone, but most indicators bound that fair market value by 66 2/3%, but that 66 2/3% is not correct. I can't tell you what it is because it took us months to determine what that fair market value is. It's less than 70%, but it's off of 66 2/3%. So our value area high and our value area low are not exactly set at 66 2/3%. Also, if you use NinjaTrader or any other platform volume, when you open up the indicator in the morning, the indicator will have accumulated no volume. So the value area high and the value area low get pushed around really easily. So if there's no look back period on your volume profile, for the first hour or so of trading, which is probably the most important time of trading, when the volume is really strong and you want to get in, get your winners, and get out, the first 1 hour to 1.5 hours of trading, that's when your volume profile is least precise. So what we did was we determined a look back period. I also can't tell you how many days this volume accumulates looking backwards. But when you open this volume profile up first thing in the morning, the accumulated look back data provides the value area high, value area low, and point of control with an enormous amount of stability to provide you with a really, really accurate volume profile. Now, here's the concepts that are really important to remember, that the point of control attracts price. This is the price that most traders want the price of your financial instrument to be. The value area high and the value area low repel price because price wants to stay within fair market value. So you've got different forces based on volume, which is extremely powerful, pressing on the price of your financial instrument. It's being pulled into the point of control. And remember, that point of control is constantly moving. It's constantly changing intra-candle based on volume profile. But remember, because you have a look-back period, it still remains fairly stable. But it's constantly doing a reassessment, and price has this strong attraction into the point of control. And it's being repelled by the VAH and repelled upward by the VAL. Everything moving to push it back into the middle, into the point of control. Now again, market profile is dynamic, because volume profile, which determines it, is constantly changing. And ours calculates the market profile intra-candle. And you're going to see how important that is. Now, if you're familiar with volume profile, you also know that there are low volume nodes. Low volume nodes are just the opposite of the point of control. The point of control is where the most volume has crossed at a given price and is a strong price attractor. These volume nodes are where very little volume has crossed. Traders don't want the price of the financial instrument to trade at a low volume node. So low volume nodes are also repel price. Let's put all that, so I want to just say that one more time before we put it all together. So you have all these forces working on the market, working on your financial instrument. You have the value area high and the value area low repelling price. Value area low pushing it up, the value area high pushing it down. Then for different reasons, you have this critical low volume node pushing price down because traders have decided they don't want to trade this financial instrument at this price. So as it approaches this price, it's going to want to back off. It's going to be pushed away. Same thing with this low volume node. So you have all these forces working on the price of your financial instrument at any given point in time. POC, point of control, being the attractor, the value area high, value area low, repelling price to keep it in fair value, this low volume node and this low volume node also repelling price because traders have decided they don't want to trade, in this particular case crude oil, at this particular price. So what we've created, and this is unique and proprietary, you'll not see this anyplace else, is what's called a zone of rejection. This zone of rejection is the space between this low volume node and the value area high to the upside, and it's the space between the value area low and this low volume node to the downside. Price is going to have a heck of a difficult time breaching this. Now, you'll note that I refer to this as a zone of rejection. This is not necessarily support or resistance, and this is not necessarily support. It all depends on where your price is. If price is below, it's got to come up into this zone. It's a zone of resistance. If price is above here, it's a zone of support. But if price breaks it, the zone now becomes a zone of resistance. And if price breaks this resistance, it now becomes a zone of support. So we just call these rejection zones. And these rejection zones are constantly changing. So our indicator only creates them on the right edge because they're constantly moving. Now, here's what I see often on these kinds of trading tools. You'll see the indicator print out static supports of support and static areas of resistance. And this is not accurate. It'll work for you for a while, but then it will fail. Support gets broken. These blue lines aren't operational anymore. They're now resistance. When resistance gets broken to the upside, these red lines aren't operational anymore because now they become zones of support. And as volume profile changes, these areas can't be static. They have to move. Now, there's another really, really important volume metric that we leverage, and it's the first time this volume metric has ever been combined in a single indicator, and it's order flow. But order flow can be calculated in a number of different ways, but we have created a novel and very, very powerful way of looking at directional bias based on order flow. Now, I think that most of you may be aware of what's called the market delta. And the market delta looks at the buy-sell imbalance in any given candle. Now, market delta, it does not accumulate on a look-back period. So when I created this slide, the only delta that was actually present was this -8 above this candle here. This -8 shows that there's a sell imbalance in this candle on a tick-by-tick basis. And you see that the market delta below it takes this jag to the downside. If you sum up all the traders sitting on the buy side and all the traders sitting on the sell side, there's an overabundance of traders looking to sell. And in that particular case, it's very likely, but it isn't guaranteed, that the price of your financial instrument is going to get pressed down. For traders looking to buy the market, then it's most likely going to be pulled up. And here's the problem with this. This is very, very dynamic. It jumps around too quickly. And if you look at this line real time, and unfortunately we can't do it today because the market's closed, and that's why I'm not going to take you to the live platform because the live platform is dead right now. You'll see this go blue, green, blue, green, blue, green, blue, green, blue, and jump. So there's got to be a way to smooth this out and leverage order flow in a way that provides you with a meaningful tool to increase the precision of your trading. And here's how we've done it. We've created order flow based on the delta of each candle on our two higher time frames. So what we're looking at, if you trade a 5 range, we're using Fibonacci numbers on a range chart. We're looking at the 8 range and the 13 range. If you're trading a time If you're trading a 1 minute, we're looking at the 3 minute and the 9 minute. If you're looking at tick and you're trading a 377 tick, you're looking at your 2 higher fib numbers. So we use order flow based on our 2 higher time frames, and don't look at order flow at all on our trading chart. What we do is we take the moving average of the number above each candle. So we're looking at, are there consistent preponderances of buys? Is there an overabundance of buy orders on each candle? Or is there an overabundance of sell orders to create a moving average on your 2 higher time frames? And it gives this indicator remarkable amount of power. Now this is an accurate representation of the color of the indicator in this market. I just put the indicator in. When order flow is to the upside on both your 2 higher time frames, this indicator is green. That's your strongest up bias. When it's blue, it's telling you that order flow is to the upside on your highest time frame. And your highest time frame always rules. So you're only going to take a long trade when order flow is telling you that your 2 higher time frames have an overabundance or disproportionate amount of traders sitting on the buy side. You're only going to take a short trade when the order flow is heading to the downside. Because in this particular case, there's an overabundance of sellers sitting on the sell side, putting downward pressure on your financial instrument. And because this is leveraging the moving average of your 2 higher time frames, it's extremely smooth. This doesn't give you a trading entry, but it gives you a very clear-cut directional bias. And sometimes the most important thing, but what can sometimes be the most deceptive, is determine what direction you want to take the market. If you're using moving averages, sometimes it isn't quite clear. If you don't use moving averages, you're just trading price action. The bottom line is this gives you a very, very precise way of determining with tremendous probability the direction that the market is going to move. Now, price goes up. This indicator isn't green because price goes up. Price goes up because this indicator is green. This indicator is not assessing any data from the trading chart. That's what gives it tremendous forward-looking predictive value in determining the future direction of price. Doesn't matter what you're trading, stocks, futures, or forex. This is the indicator that's going to give you a tremendously powerful directional bias. Now, intra-tick, and again, this is a lot of information to assimilate, but I do want to expose you to all of it. Intra-tick, you also get a buy-sell imbalance. And this is called the volume ladder. And this is just a visual representation. I can't show it to you today because it's Saturday. And when we open the platform, this does not accumulate on a look-back period because it's just not necessary. But what happens is that there's a tremendous overabundance of buy orders, you get this dark green. If there's a moderate overabundance of buy orders, you get this blue. Now, this does not guarantee that the market is going to continue. All it tells you is that when the trade swings back around and is going to come back in the direction that there's a huge amount of buyers sitting at this tick level, or this price level for a stock, or this value for a forex pair. And when you start to sell into this overabundance of buys, this acts as a fairly, it's a moderate area of support. Not strong, but it's there. And it's an independent and it is an independent variable that should be taken into consideration when you're taking a trade. Just look at it and be cautious and put that into that list of independent variables that you want to align with you in order for you to take a trading entry. This is all on one indicator for the first time. Skip that and that. Now, I wanted to show you actual trades. This is real price, and this is real order flow. Now, the reason I took the trading instrument off the chart is I don't want you to think in terms of, is this crude oil? Is this gold? Is this the pound dollar? Is this Google? Is this Netflix? What is the size of the candle? Is it an 8 range? Is it a 377 tick? Is it a 2 minute? Is it a 6 minute? Is it a 9 minute? All that information is irrelevant because it's operational and effective on any of those. That's why they're not here. Price comes back to this zone of rejection, acting as support. Order flow is with you on the trade. You take the bounce, you enter 1 tick above the close, and here you're going to go up 7 ticks, or you're going to go up 7 cents on a stock, whatever you're trading. But you know the direction, and here's support. It comes back to support. Order flow is with you. Take the trade right back up. There's an overabundance of buy orders on your 2 higher time frames telling you that there's tremendous upward pressure on this financial instrument to go higher in price. And it almost always does. Price comes back to support. Order flow is green, your strongest up color. This one goes 31 ticks, 31 cents, 31 pips. It does not matter. Then you move up to resistance. You're into resistance here, and you can't short the market until order flow goes red. Then the market is telling you that there's an overabundance of sell orders on your 2 higher time frames. Most people are sitting on the sell side. The red color is the most powerful because it tells you this is occurring on both higher time frames, and you see the market collapses. Now, we would take trade off at support. That's the 33 ticks, pips, or cents. But in this particular case, that overabundance of sell orders never stopped, and this just smashed through and went all the way down to here. I didn't even track it. It's probably about a 60-cent tick or pip trade because I would take the trade off at support. Now, what we look for is a retracement back to resistance and a continuation to the downside in the direction of order flow. Now, here's another trade. And this is the importance of minding order flow. Now, this price comes back to support, but order flow is angled down. So you can't take this long trade. If you do, you're going to take it with a considerable amount of increased risk. It doesn't make any difference that the trade worked. When you're trading the right edge and all you see is this candle sitting on support, but order flow angled in the wrong direction, you're simply going to stand down and leave the trade alone because the probability is against you that the trade is going to be successful. Now you have a potential short here at resistance. Order flow is against you. You can't short the market. It doesn't move down very far and comes right back to resistance. Order flow is against you, and you can't short the market. You've got to wait. Finally, price breaks, comes back to the point of control. And remember, point of control is resistance. And now you have order flow with you. Here's where you short the market, and you get 61 cents, ticks, or pips on that trade. Always trading in the direction of order flow. These trades are more likely to run you over and stop you out than they are to give you a successful trade. You never worry or fret or look back on these and say, I should have taken this trade. Just stay in the direction of order flow. It doesn't make any difference if it costs you winners. It's going to help you avoid a huge number of losers. And here's another trade. Now, Japanese candlestick dogma tells us that an area of support or resistance is only broken when 2/3 of a candle body closes above an area of support or resistance. Now, this price is moving through this zone of rejection, and you can see how price is captured in here. It's very difficult for it to move through, but eventually it does. Now, you can take the trade here, or you can take the trade here. This candle, where the first blue arrow is, doesn't fully break resistance to the upside. You only have about 1/3 of the candle body through. If you want to assume additional risk because you have green order flow, it's going to give you 8 ticks, pips, or cents more profit. If you want to wait for the more conservative entry, you're in once this area of resistance is formally broken and price rolls to the upside. Now, this is a trade I took in our trading room based on order flow. And what I had price break, pull back to support. The zone is right here. I had to put it in because I'm not on the right edge. I traded in the direction of order flow, and price went up 6 points. And that's on the E-mini. That's a huge move. That's a lot of money. And you can see in every tick, you've got that volume ladder. There's an overabundance of sell orders in this tick, overabundance of sell orders in this tick, overabundance of sell orders here. This will pose not only as no area of support or resistance, it's going to help pull this trade down. It's going to help you move through. Because what's sitting here are a lot of sellers, and selling into these sellers is going to help push the trade down. Here's your first area of support on the swing around of price. Now, here's where you stand out and you quit. When these volume zones or zones of rejection become confluent and price gets trapped in between and order flow starts to stutter step, green, yellow, this is when you take your hand off the mouse and you say to yourself, I am not going to trade, because the likelihood of getting a winner is exceedingly low. What you have to do, and it may take a considerable amount of time, is to wait for price to break through resistance to the upside, break through support to the downside, have order flow in your direction, and then you've got yourself a trade. And there's one more thing that I want to mention that's extremely important, and that is the wider the zone, the weaker the zone. When the critical low volume node separates from the value area high to the upside, and the critical low volume node separates from the value area low to the downside, both of these become weaker. They become stronger when they act in synergy, and they're maximally synergistic when they're right on top of each other or really close to each other. Then you have the value area low pushing price up to stay in fair value, and you have the point, and you have the low volume node pushing price up, because that's a price that no trader wants the price of this financial instrument to trade. Two distinct forces confluent with each other, both pushing price to the upside or both pushing price to the downside. So when they separate, they weaken. So you actually get a visual representation of how strong this area is. Because if you have all of your other independent variables aligned with you, and the only thing that you have to ask yourself, is this area of support or resistance going to hold? You can make a fairly accurate assessment based on the width of the zone. If the zone is narrow, you're just never going to make the assumption that zone's going to break. If that zone is extremely wide, then you can make the assumption. there's a good likelihood or a fair likelihood that the zone is going to break and price will move through it. Now, here's another trade I took. Here's the zone. It's support. It's broken. You get a pullback. This is our modified 15 period moving average. I took the continuation trade to the downside. It's on crude. It's 18 ticks. It could be any financial instrument. It could be 18 ticks, pips, or cents. This is only an 8 range. It's a short range chart. But I took the trade because I'm trading in the direction of order flow, and there's a tremendous amount of excess sellers looking to pull this market to the downside. Here's the same thing happening to the upside. You break resistance to the upside, and this candle is sitting right on top. Now Japanese candlestick dogma is working for us because 2/3 of this candle body is through this area of resistance, and now resistance is acting as support. And you're trading in the direction of order flow. Throughout this whole period of time, your bias is short. You're looking for a short entry. No entry appears, but that's your bias. Now you're looking for a long entry on the best long and strongest long color that we can muster based on order flow. And with this green color, we know that there's a tremendous overabundance of traders sitting on the buy side, looking to push the price of your financial instrument to the upside, and up it goes. This is 2.5 points on the E-mini. And I'll tell you, instruments like the E-mini, forex, bonds, notes, you don't want to trade against order flow. Now, I want to go, that's really the end. I'm going to just show you what I'd like to offer you. With the indicator, with the system, we're offering you 3 months in our live trading room. And I'm the person who takes these trades. And I tell you that we don't make money every single day, but we make money almost every day. In the last 15 trading days, we have made money 14 out of 15. I trade with Chart Trader up. All my stops and targets are projected onto the trading chart. Everything's in front of you. I pull my Ninja Trader my Ninja Trader control panel over. I take the profit on each trade off the control panel, and we take our tally for the day off of my control panel. Everything's incredibly transparent. If I make money in the room, almost everybody in the trading, we have 65 traders in the room that are there every single day. Almost everybody makes money too, and their equity is very close to mine. And you're going to be in there for 3 months. If there's any fuzziness or hesitation about this indicator, after being there for 3 months, you're going to be able to trade it like a pro. In addition, we're going to give you 3 months of our NDT trade execution platform. I don't have time to show it to you, but it's a patent pending tool. We submitted it for a patent 2.5 years ago, and it's still in front of the patent, whatever the attorney is who sits and evaluates them, because we have a tracking number, and he's still sitting and looking at it, and getting these kind of these coding patents through is now extremely slow. But it's a very unique trade execution system for getting into a trade. It minimizes slippage. It increases the precision of your entries. And it's really going to help your trading performance. Like I typed, it enters the trades with a lot less slippage and greater precision. If you're trading a time chart, or you're trading a tick chart, and you want to get in 1 tick above or below the close, you don't know where the close is going to be. All you have to do is press a button on this platform. It's going to execute the trade for you electronically 1 tick above or below. It very rarely misses, and you just can't do that with this kind of speed. You will incur slippage. This system will not. In addition, During the 3 months that you're in the live trading room, every Wednesday, I give a didactic session, really a training session on how to trade. And these principles are fundamental to trading any financial instrument. It doesn't matter, again, whether you're trading stocks, forex, or futures. Price movement, market structure, order flow, volume, the multi-time frame alignment of direction are all operational on every single financial instrument. That we are going to put you in that group of traders who have paid a very large amount of money for our trading school. And you're going to get 12 lessons. So again, if there's any haziness, not only about this indicator, but about our system as a whole, you're going to learn it. We also give you access to our video tutorial library that we don't show to anybody. These are all my training videos. There's probably 150 hours of videos in there to teach you how to trade any financial instrument. There's videos on the forex. There's videos on stocks. There's videos on futures. Whatever financial instrument you want, you're going to get to dial in that video. It's very, very straightforward once you get the link to access the tutorial library. And what we're going to do is we're going to give you chart templates for a dozen different markets. So if you decide you want to trade a financial instrument that's different than the one that we trade, we're going to give you a template. Let's say that you want to trade a tick chart, and I'm trading a range. Let's say you want to trade a time chart. Our charts are complex because they all do all of our indicators assess data from multiple time frames. So it's easy to learn if you want to, but what we do is we just put in all the numbers for you and pop you the templates for all the higher time frames, so you don't have to worry about it. And it's a lot of work for us, and we're going to give you a dozen markets. And normally all of that is $9.99 for the indicator. It's $27.93 for the bonuses. We're going to give it to you all for this webinar special of $799. And essentially we're almost giving you our core methodology, our most important trading tool, all of our videos. And I really think that after you're done with this 3-month experience, you're going to have evolved into a profitable, successful day trader. Now, I just want to give you our word, www.rightlinetrading.com, info@rightlinetrading.com, 1-855-765-6681. And what I want to do is I just want to put the buy link in, and then I'm going to answer any questions that you have. Excuse me, I'm squeezing this over, and it may come in here. But I'm by myself here in the office on Saturday because everyone's abandoned me. So I got to do everything here by myself. Just let me put that in. I'm going to put it in twice just to make sure I get it right. And that's the buy link. Now let me just go over and take a look at the screen and see if there are any questions. Hang on one second here. Questions. Okay. Let's see if I'm doing this right. Oh, here they are. I got them. Hang on one second here. Hold on one sec. I'm going to have to do this really quick because there are a lot of questions, and I'm not going to have time to answer a lot of them. Now, remember, if I don't get to your question, okay, this is from the start. Let me just roll to my time here at 11 o'clock. Here we go. Okay. This is at 11:03. Okay, all right. These are still questions for the previous speaker. Okay. Thank you, Bill. Thank you. Hold on, I'm still scrolling here. Okay, people are just talking to themselves here. Let me just move quickly because I know the time is, I don't want to overstay my time. All right, Richard, you ask, is there a problem that constantly the information going to the institutions and the subsequent orders are changing, and the valid areas where there are reasonable high or low price zones is also changing? As soon as one draws the lines, they get changed by new information. Isn't it possible that the order flow to the point where the past fund go from? Well, here's what it is, Richard. Because we do a look back period, the volume profile becomes fairly stable. So as volume begins to accumulate, it doesn't really shove market profile around very much. Market profile develops a decent degree of stability. So what you're looking at is actually a very, very accurate representation of volume profile. It isn't quite as labile and twitchy as you think it is. Because we do that look back period, all these areas have a nice degree of stability. You will see some intra-tick recontouring on these zones of rejection, but they're really fairly stable. And if you're going to take a trade, and by the last tick, those rejection zones have not changed, they're very unlikely to change after the trade ticks in and you're into the trade. That's really what you want to avoid, a jump at candle close. And that's what happens on an indicator that waits to assess on candle close. It stores up all this information and then makes a big jump. If you're trading a 3-minute or a 6-minute or a 9-minute, it won't adjust until that candle close every 3, 6, or 9 minutes. That's where you've got the problem. It can be any time frame, Selwyn. It doesn't matter. They can be time, tick. You can trade Renko. It's all irrelevant. And this is only for NinjaTrader Mitch. And you can use this on any time frame. It can be for day trading, swing trading. It does not matter. The exit cherry is based on taking the trade off as the trade moves up into resistance or down into support. What we do is on each financial instrument, we look at the average true range of the instrument going back 2 years, and we optimize the exits based on our automated trade management strategy, which really provides us with an optimized removal and moving out of the trade. Slowly moving out of shares, moving out of lots, taking profit on our contracts as the trade moves in our direction. What you said. Hold on. What are the numbers of what they are, Sherry? Is they're 15-period proprietary moving averages. That is the moving averages for the 2 higher time frames. And what you're saying, JT, is right. But what I did was I took those trades when the market was closed. So the VAH, VAL, and all of that information was static. And so those areas were no longer moving. And so they were all just sitting there. And that's when I shot the slide. That's a really, really smart and very insightful comment, though. And it does work. Listen, there is order flow on forex. Listen, if you look at your NinjaTrader, there's always a number of traders sitting on the buy side, and there's a fixed number of traders sitting on the sell side. That is order flow. Every financial market has to have that, Doug, and it has to be present on the forex. Okay. This is what I showed you is a standalone software package. All you need to have is NinjaTrader, and you will get everything that I showed you formatted. We format it for you. We get our tech guy here who's really brilliant, and he'll format it for you by moving onto your chart and setting it all up. Robin, if you make that much money, congratulations. I'm telling you. You shouldn't be in this webinar. We always give you a license for two computers, Rob. Always for two. Correct, Rob. That's what it is. The upper and lower zones, order flow. It's $7.99. Is this the only training or software is being given? Mahesh, if you want me to work with you, just call the office and I'll work with you on Monday. I'll show you more about the indicator. If you have our number, we're good. Listen, I don't want to overstay my welcome. Everyone's being very, very polite to me. It only works on Ninja. We're going to be on Sierra soon. Ongoing costs after 3 months are zero, Ralph. If you want to stay in the room, there's a small fee for the training room, but the indicator is yours for life. All the upgrades, modifications, we always give those to you for free. You have nothing else after 3 months, except if you want to remain in the room. That's what happens after 3 months. But after 3 months in the room, and in the last 15 trading days, I've only taken one losing day, you should be up enough money where the trading room is really part of the cost of doing business. It's a NinjaTrader thing, Robin. Roseanne, I do. If you give us a call on Monday, I'll show them to you. There will be another opportunity to join them. I'm sorry, I'm going this so fast I'm not reading it. It works on NinjaTrader. Always lifetimes, TradeBuster. If you ever have a problem, we will upgrade everything. We don't offer VWAP on this, Roseanne. I haven't found it to be helpful. As long as you have order flow, the volume ladder, and the market profile, that's just my opinion. All right, listen, I'm gonna go. There's too many questions here for me to get to, and I really apologize. Listen, thank you so much for everyone for letting me have this opportunity to talk to you. If you have any questions, just call the office on Monday morning. We'll be happy to talk to you. We're here all day. Again, thank you to everyone, and thank you, Robin. Have a great afternoon. Enjoy your weekend, and no matter what you do, I really wish let everybody in this room. Let us be the group of commercial traders that takes the money away from the others. And let's keep these institutional traders with us on these trades. Take care. Have a great weekend. Bye-bye. Thank you all.